Probably not. So then what can you do? You can try hedging. So hedging is when you use financial instruments such as options or future contracts or other market strategies to reduce the risk of adverse price movements. So here is the price of oil per barrel, and here are the earnings. The higher the price of oil, the lower the earnings of the firm. If you hedge, you can, for example, uh, get an oil price of 23 in the future, which means that your earnings will always be 140 million. So hedging basically offsets the risk, but also means that if the price of the oil goes down, you are losing this revenue. But a lot of companies say it's okay to lose this revenue if we can prevent losing, massively if the price go up by a lot. Lower risk is often preferred, and sometimes not. But in this case, with oil, is something that is very common. So, example 5. Firm A produces tables. It needs 500 kilos of wood the next year, and the current price of wood is $5 for 1 kilo, which causes the firm to have an earnings before interest tax of 100,000 next year. I'm going to do the first two, and you guys are going to do the exercise afterwards. Question C. So what is the expected next year's earnings before interest tax if the price of wood rises to $7 per kilo? So we had the 100,000 EBIT, and if the price rises with 2, so that's $7 minus the 5 that we expected, then if you buy 5,000, you're going to pay 5,000 times $2, which means your costs are going to be $10,000 more next year if the price of wood goes up by $2, which means that your earnings before interest tax is not the expected 100,000. If the price of wood goes up by $2, it's going to be 90,000. And what happens if the price falls to €3 per kilo? Well, then it's quite the opposite, right? Because now it's going to be minus 5,000 times minus 2. The price goes down. So basically, you're adding 10,000 extra to your earning before tax because you can buy wood at a cheaper price. Now, a question to you. What would the earning before tax for both scenarios be if firm A decides to enter a contract with the company that sells them wood to allow them to buy the wood at a fixed price of $6? I'll put on the screen the poll. And then we'll walk through it together afterwards. All right, I'm happy that everyone who answers has found the right answer. Let's quickly go over together how it's solved. So in this case, we do the exact same thing. We have the earned for interest tax of 100,000, and we're going to do it minus the 5,000 kilo of wood we're going to buy, and the price is going to be 6 instead of 5, so it's going to be 1 higher, which means that the earned for interest tax is going to go down by 5,000 to 95,000 euros. You can say like, okay, why do they do this? The current price of food is 5 euros. Why are they agreeing on a price of 6? Well, the price could, it could be 7, it could be 3, but for the firm, they want to offset the risk that the price is going to be higher than 6. And the firm who's selling the wood to them, they will probably not accept a price of 5. They might expect the price of wood to also go up. So this is the price at which the two parties have agreed, okay, that's a fair price to be buying it in the future. Now, hedging with futures contract. So a agreement to trade an asset on a future date with a price that's locked in today is called a futures contract. So one thing that's important to know is that you will not actually deliver the asset with a futures contract. What you do is, and maybe it's on here already. Okay, it's not. So basically, what you do is, I have an agreement that I'm going to buy wood for 10, and if the wood price is 8, then I'm basically paying $2 per kilo of wood to the person I made the contract with, and then I buy the wood for 8. So essentially, I'm still buying it for 10. But if the price of the wood is above 10, let's say it's 12, then the person who I have the contract with, they're going to pay me $2 per kilogram of wood. So they're going to give me $2, and I'm going to then buy it for 12 on the market, 10 myself. So again, I'm spending 10. So with a futures contract, you can set the price steady on a certain price, and then still you're going to have to buy it yourself. So the person you have the contract with is not actually going to give you the asset. They're going to give you the difference between what you agreed upon on the price. So they're traded anonymously on a public exchange, which means they are very liquid. Unlike with a contract that you have with a company, you could decide to sell this contract on the market for the current market price at which these contracts are selling. So any party can just get out of it by selling it to a third party on the public market. And they eliminate credit risk by their marking to market feature. And that's something we're going to go in a bit later. So hedging with a futures contract, when entering into a futures contract, the firm has to put up an initial margin account as collateral in the margin account. So what does that mean? You go into the contract, and to make sure that people don't default on it publicly, because it's very anonymous, you have to make a margin account, and on this margin account, they're going to take basically the loss or add the profit that you make to make sure that people don't default on their contract. Because otherwise, if I can buy the wood on the market for 8, and I've agreed to pay a price of 10 with someone else, I can just be like, you know what? Never mind that contract. I'm not going to pay them. I'll just buy it for 8 on the market. But by having a margin contract, have a margin account, you make sure that both parties will be paying, what they're owed. How does a margin account work? So every single day, the gains and losses are computed, and they're either added or subtracted from the margin account. So let's say we agreed to a price of 10 per kilo of wood. When it is 10, basically no one's making a gain or a loss. The next day, the price becomes 11, which means I'm making a $1 gain. They're going to add $1 to my margin account. The next day, however, it's going to go back to 10. Now they're going to subtract $1 from my margin account. We're again on equal terms as we have in the contract. And this is going to happen every single day till at the end of the period. You are going to, let's say the wood ends up being priced at 9. I'm going to have my margin account is 1 less than what I started with, and that's what I'm going to get back. And the person who's on the other side of the contract, they have added 1 to the margin account when the margin account expires and get paid out again. such that the minimum maintenance margin amount is held every day up to expiration. Now, what happens if, let's say, I've got $10 in my margin account, and over all of this time, I have 10 contracts for the wood, and the price goes down by half a cent. They're gonna take 10 times half a cent or half a euro. They're gonna take 10 times half a euro off, which means if the next day the price goes up with half a euro, they're going to take 5 out of my margin account and it's going to drop from 10 euros to 5. If the next day it again goes down by, again the price goes up by half a euro, they again are going to take 5 out of my margin account. Now, what happens if your margin account reaches 0? It means you're going to have to top up your margin account or you're going to have to sell the contract with the loss on the public market, which means you actually incur the loss at that moment. Example 6. A firm buys an oil futures contract at a price of 87 per barrel. The next day, the price per barrel decreased to $85. Therefore, this is a negative profit, and as such, it has to be deducted from the margin account. The next day, the price per barrel goes up to 88, which is a profit. So $1 per barrel is immediately added to the margin account, and so on. We notice that the margin account shows the difference between the futures contract and the current price of the oil. So whenever you look at that day's margin account, the gain or the loss you have is simply sort of like the strike price you have, the agreement that you have to pay for the barrel of oil, and the actual price of oil at that moment. And every single day, the margin account is going to get a loss or an extra if this price changes. So for instance, after end periods, the price of oil drops to $65. Now the margin account is at a loss of $22 per barrel. Well, basically it's at a loss, which means that in fact you have to buy the oil for 65, and you have to give $22 to the other person who is who is basically the other person who received $22. So when you get back your margin account has dropped by $22 per barrel, and you can buy the barrel of oil for 65. So essentially, you're paying 87 per barrel. The other person in the contract, their margin account went up with $22 per barrel, and they have made a profit of $22 per barrel. Here is a little explanation, which you can read if you go over the slides yourself again.